Hey, this is Mike, and I wanted to do a little bit of an educational video on trading. And this is something that I learned that helped me become a much better trader. And I always say learning about trading psychology stopped me from being like a gambling trader and being sort of a more smarter, systematic trader. And so if you're just starting out in trading, chances are you may feel like trading stocks and options is almost frustrating because it feels like you're just getting these bad trades that are just wiping out or breaking your portfolio. So hopefully this video will help kind of change your perspective or gives you a little better understanding on how to make trades that are less likely to result in bad trades that could blow up your portfolio. So I'm just going to call this video using trading psychology to stop bad trades. And this entire video, all the information here is inspired by Mark Douglas's book, Trading in the Zone, which you can find lectures about the book on YouTube. Just do a YouTube search, Trading in the Zone. I think you may find the audiobook. You can find summaries of the audiobook. You can also find these great lectures that Mark Douglas has done. He's done like 1 hour lectures and 2 hour lectures and 6 hour lectures, and they're really worth it. It can really change your whole perspective on trading. So I'm just going to give you a little summary of what he kind of taught about trading psychology. So fundamentally, there are only two things that really cause bad trades, and it's the two emotions of greed and fear. When you get greedy, you're trying to squeeze too much money out of a trade, and when that happens, the trade can turn against you, and then you end up losing money. And fear, maybe you see a stock rating up and you fear you're going to miss out, but you enter that trade too late in the game, and you enter the trade at the top of the market, and then the market collapses under you. So these two emotions are really the core reasons for bad trades, greed and fear. And I'm going to show you a parallel between the stock market and really casino gambling later on in the video. But the whole point is when you use greed and fear, it's like one bad trade can negate a lot of good trades. Like you could have like 5 good trades, but then you get in that one bad trade and it could wipe out all the profits you made in those 5 good trades because you get in that bad trade and you don't want to sell. You stay in the trade, the stock keeps going down, and then that one trade just kind of wipes you out. So if you can stop greed and fear, you can stop bad trades. The only problem is it's almost you can't stop your emotions. You can't become like a Vulcan like Mr. Spock on Star Trek. But what you can do is create more a systematic trade and understand how the stock market works. And that will help you remove the greed and fear because it kind of removes the uncertainty of the market by accepting that the market is completely random. So the first thing you have to know is that anything can happen in the stock market. Literally, the stock market could open up on a Monday, like the next day, and it'd be down 20%, or it could be up 20%. Literally, anything can happen in the stock market because every trade is a random event. Nothing has to happen. You could have the market go up 5 days in a row, and the next 5 days it could still go up, or it could go down the next 5 days. So every trade is a random event, and you don't need to know what will happen in the stock market to make money. And the great parallel is a casino. So stop thinking about how to make money in the stock market and learn how to not lose money. And the best way to not lose money is really to find your edge. Now, like I said, like a casino, the stock market has several edges in it. And if you know those edges, then you play to those edges. So here's just a couple of examples of edges. The S&P 500 moves up on average 9% a year. That's one edge, and I think everybody knows about that. The stock market is higher today than it was 10 years ago. It's higher today than it was 20 years ago. On average, it moves up. Now, you could look at any random 5-year period, and the S&P 500 might be down in a shorter time span, or even a 3-month time span, or 1 year or 5-year time span. But over, like, let's say a 10-year time span, it's going to be higher than where it was. And here's another example of an edge. If you sell options at a delta 30, you have a 70% chance of that option expiring worthless. A delta 30 tells you basically the odds of that option expiring worthless at the expiration date. So delta 30 means a 70% chance of expiring worthless. If you sell an option at a delta 20, that's an 80% chance of the option expiring worthless. These are two examples of edges. Now, the way to make the edge work to your advantage is you want to trade small and trade often. So again, I'm going to draw a parallel to, let's say you have a casino. A casino trades small and often, and they're mechanical. So let's do the example here. Let's pretend we're going to open a casino, okay? Now, the casino, every casino has an edge or they would not remain in business. However, in order to maintain that edge, they have to accept a lot of bets, right? A casino can lose the edge if they don't accept a lot of bets. So let's say we start our own casino and it's an off-strip casino, so it's not like the Bellagio or Caesar's Palace. It just makes the math a little easier. We're going to call it the Outlaw Edge Casino. So this is a casino that's sort of on the outskirts of Vegas. Maybe you get some truckers and drifters who come in to play like low-stakes blackjack and stuff. And out of all the games in the casino, you take the blackjack, the baccarat, the video poker, the sports book, and all that, there's a 3% edge. So that means for every $1 a gambler bets, we get a $1.03. So let's say this small casino every day accepts $1 million in bets a day. That casino can be projected to make $30,000. So in order to make that $30,000, you want to make sure that those $1 million in bets are as small as possible. So for instance, let's say we have two choices. We have gamblers that can place 100,000, I put trades, it should be bets, at $10, or we have a gamblers place only 10 bets of $100,000. Now, we have the 3% built-in edge. If we accept 100,000 bets, it's much more likely that we're going to, at the end of the day, we're going to get our $30,000 because the edge over 100,000 bets is 3%. Chances are over a lot of bets, we're going to get our 3% edge of $30,000. However, if we only accept 10 bets of $100,000, we may have one gambler who gets on a lucky streak at the blackjack table and wins all 10 bets in a row, and we don't make our $30,000. In fact, we lose all of our money. So the way you can apply this casino example to trading is you want to trade, you want to find your edge and trade a lot because that smooths out your curve and it smooths out your ability to make profits. So it's a lot better when you find your edge to make 100 trades rather than 10 trades because you could have 10 losing trades in a row. You know, if you go to random.org, that's a website that you could do random numbers, you can find out even if you have a 70% edge, like if you sell Delta 30 options, it's quite possible you can lose 10 of those trades in a row. Like just imagine if you follow sports, like say you have a first place team. There was a time a couple years ago the Dodgers were winning 65% of their games. However, they went on a 10-game losing streak and still had a 65% winning percentage at the end of the season. So even with 65% or 70%, you can still have 7 or 8 losing trades. So it's really all about the trading psychology is to remove the fear and the greed by just finding your edge and placing as many trades as possible. So I definitely recommend, and it's a great read. It's not a dry read. And if you don't like reading, you can check out the audio book or his lectures, Trading in the Zone by Mark Douglas. I can't recommend it enough. The book came out in 2000, and it'll really set your mind straight if you're trying to be in the right mindset for trading. And you could also check out Mark Douglas's lectures on YouTube. They're all over YouTube. So I hope you enjoyed this video. If you did, please be sure to like the video and subscribe, turn on notifications. I come out with breaking news on the stock market when the stock market's open. And on the weekend, I do these sort of, little educational videos to help people out. Okay, thank you very much. Bye.